Well, Rob, we saw a bit of a recovery in the local markets earlier today after those losses on Friday and yesterday. But since then, we have dipped into the red. And we chatted about an hour ago, the market was 1/3% higher. It's now almost 0.5% lower. But it does seem pretty directionless.
It is a little bit. The volumes are also quite thin. I think just before I left the desk, only 1.5 million Anglos are traded for the whole day in a range from about 300 Rand to 306 Rand. So there's not a lot happening in the market at the moment. And I think still from futures closeout, which was pushed the market quite aggressively to the upside last week, Thursday, Friday, we're starting to see some profit taking and some people just rebalancing their books as well.
But at the same time, we are seeing some of the key US indices hitting new 18-month highs. We had the S&P 500, the Dow and the Nasdaq all up sharply yesterday. The Dow gaining 1,000 points and close to the 11,000 level. But we're not really taking our cue from them, it would appear.
Well, we are obviously. If you take a look on the IT sector, we saw Apple and we saw Cisco Systems at a 52-week high, as well as we saw some industrials come through, like Caterpillar yesterday in the States coming through. And if you take a look, our IT sector looking relatively firm today, and so we are taking a view there. But the problems in Greece and the fiscal problems in Europe are still weighing slightly at these levels. The market is looking relatively toppish, and I think people are just quite cautious at the moment, Stephen.
And of course, we are having those European ministers, or leaders rather, meeting over the next couple of days, and Greece likely to be on the agenda at some point in that meeting. What do you think the market would like to see coming out of that European leaders meeting?
I think obviously they want Greece to be supported, and they don't want to be lulling for weeks and weeks to find out a solution. They want something clean and something that will help Greece straight away. And if it's going to be a long process, at least show the points and the steps that they're going to use for it. At the moment, we're starting to just get drawn out process, and I think that's starting to make people worry a little bit.
Of course, Greece is just the peak of the iceberg. We know that there's mounting sovereign debt in a number of countries across Europe, and that's likely to come to the forefront in coming months as well, isn't it, Rob?
Yes, the fiscal debt is a really big problem, as well as with unemployment. Now, if the employment starts to increase and we start to see people getting their jobs back, I think that you'll start to see the economy start to produce a lot of revenue, and you'll be able to get out of that fiscal debt. But without a lot of employment and the consumer starting to push these economies, fiscal debt is going to start to become a problem.
Of course, having said that, we had some positive economic data coming out yesterday, also some signals that employment in our economy could start to be on the mend. That was fourth quarter figures that came out yesterday. We also had the quarterly bulletin out yesterday, and the current account deficit surprisingly better than expected at 2.8% of GDP in the fourth quarter of last year.
Yes, our quarter bulletin was definitely much better. The economy is looking like it's recovering better than most people expected. I think we picked up about 12,900 jobs after losing about 98,000 the quarter before. So we are starting to see a mend. We saw some of the sectors like manufacturing are still losing jobs, and we need to start to get that part of the economy running. But with very big fiscal spending coming from our side, from our government on infrastructure spend, I think that we could start to see that employment carrying on picking up over the next few years. They're looking to spend about 200 million every year. So we're going to look at about $1 trillion over the next 5 years in infrastructure spend, and I think that will definitely increase employment in South Africa.
Of course, we had consumer inflation numbers just out a short while ago, earlier this morning, 9 o'clock. CPI at 5.7%, and of course we have the MPC meeting today and tomorrow. Do you think that this is going to be the swaying factor that could cut interest rates again?
I think Nedbank economists look at about 13 different factors, and of those factors, 9 of the factors say that they should be unchanged, and 4 saying that there should be a change. Our view is that we're about 69% that there will be no change in the interest rate tomorrow, and just 31% chance of a cut. I think obviously that the CPI coming back into the range, it does give them leeway to cut the rates. But at the same time, that quarterly bulletin showed that the recovery in the South African market is definitely there, and there's no need to cut in that respect as that economy starts to grow again.
Of course, we do know, Rob, that our higher interest rates have been influential in that carry trade that's bringing portfolio flows into South Africa. Figures out in the quarterly bulletin yesterday showed that 107 billion rand came into South Africa in the form of portfolio flows last year, and that really supporting our markets. I mean, do you think that we're going to continue to see that magnitude of foreign investment coming into our market?
I do think so. I think even if we did get an interest rate cut, if people are receiving 8%, now they're receiving 7.5%, the differential down to the stage where they're getting it at 1% is still very large, and they'll still put that carry trade on. So I think even with the interest rate cut, we'll start to see that. I think emerging markets are still the place to be. China And Brazil and India are going to get a lot of flow and a lot of growth coming out of them, and South Africa will fall into that group, and there will always be allocation into emerging markets for the next for the foreseeable future as the Western economies grow at a much slower pace than the emerging market economy. So definitely I think that inflow will carry on over the next year or 2 years.
Well, Rob, as we see our economy start to recover, what sort of stocks would you be looking for on the JSE? Which ones do you think are going to attract that investment?
I think some of the general miners, if you take a look at Anglo American and Billiton, from their highs in 2008 where Anglo's was at around about 550, it's only trading at 300. As we take a look at the banks, they're already at all-time highs. So I think that if that economy starts to move, I'll take a look at those general miners. One or two of the industrials as well. You can take a look at one or two really oversold and really battling firms such as the yellow metals firms like that do Caterpillar, Equestra and Barlows. I really do like Barlows. And if the economies do start to recover quicker than people think, like Barlows in the industrial sector as well.
Rob, we had those US existing home sales figures out yesterday, a little bit weaker, but then, as Alicia said, taken in a positive light by the bulls in the market. We're looking for durable goods numbers in the US, new home sales, jobless claims as well. Do you think those are going to really direct where the US markets go from here, and obviously our markets as well?
Everybody is looking at those numbers. I think if there's a really bad number, the markets will be affected, but anything within a 1/4% either way, I don't think will affect the markets too much. So really what you're looking for there is a big spike. So if new home sales are excessively better or excessively worse, it will make a big difference to the market. But anywhere near what people are expecting, I don't think it will impact too much. Durable goods is quite an important number, so we'll be taking a look at that later this afternoon.